Remember when you were in grade school and went through a fire drill? Or if you've been on a cruise, you likely participated in a drill mustering at a certain section on the ship with your life vest on. These practices prepare you for how to act in case of a real emergency. Similarly, we think conducting an investor fire drill makes sense so investors will know what to do when the market next suffers one of its normal temporary declines. A financial fire drill will demonstrate the frequency and magnitude of a market decline and reinforces the point that global markets have always recovered. Being disciplined is very important during a market decline, and the opportunity costs of bailing out at the wrong time can be large. Even if you are correct 70% of the time in timing the market, which is better than most, it doesn't take long to have the probabilities working against you. Mathematically, to get out near a top and back in near a bottom at a 70% probability of being right is 0.7 times 0.7 or 0.49 or less than a toss of a coin. Add one more trade and you're at 34% or about a third of a chance of getting it right 3 times in a row. So we advocate knowing how the markets tend to act and preparing in advance how you will respond, and we'll call this a financial fire drill. Exhibit 1 shows how the MSCI World Index has weathered the last 5 major market declines of at least 20% dating back to the 1970s. On average, they occurred about every 8 years, with declines ranging from 20% in the fall of 1987, do you remember Black Monday? Or to 54% in the more recent financial crisis of 2008. The declines lasted from a short 3 months in 1987 to a long 30 months after the tech bubble burst in 2000. The takeaway is how the market responded in the years after the start of the downturn and off the subsequent bottom. Starting with $1 million portfolio and looking out 5 years from the then market top, the portfolio balances are well off their lows by then, and looking 5 years out after the market bottoms, the values are well above the beginning $1 million starting point. Opportunistic rebalancing when individual positions get out of balance, forcing a buy low, sell high discipline would add to these figures that are shown. Feeling the heat or the stress of the market decline is also important in an effective drill. Exhibit 2 shows the index during the worst decline of our time and its subsequent recovery. Do you remember how you felt during the decline? I know the news shows made me feel awful. Unprecedented financial chaos was the byword of the day. But the headlines remained negative long after the bottom was in, and only recently has there been a whiff of decent news. And even that has been quickly offset by concerns around valuations and the potential for rising interest rates and terrorism and global warming, and the list goes on. The point is, markets by their nature are volatile. And knowing this on the front end, and knowing your goals, time horizons, and risk tolerances, and working through the fire drill in advance of a market decline will improve the odds of having enough cash for your short-term needs and staying the course with your longer-term resources. Remember, the markets on average return about 10% per year. 10% a year. Get that 10%. Don't get in and out.